Hello and welcome to double entry bookkeeping. The money in, money out method, which we're going to use as the start of AAT Level 3 Bookkeeping Transactions course. What we're going to do is we're going to really polish up our double entry bookkeeping before we start AAT Level 3. And this is important because you might have been able to get through AAT Level 2 with not the correct technique for double entry bookkeeping, or not being totally precise, but a higher standard is going to be required at level 3. And so what we're going to do in this lesson is we're going to polish it up. So what we're going to do is we're going to understand what double entry bookkeeping is in terms of just simply recording the money movements for a business. So we're taking and stripping away everything else. We're going to get back to the underlying principles and see how this is about recording money movements for a business and how we're going to understand those money movements. We're going to then have a technique which we're going to remember for creating double entry bookkeeping. You know how I do everything in accountancy always has a technique behind it. There's the understanding of it first, and then we do a technique which we just apply then again and again. So we're going to remember that technique. We're going to apply that technique to create the entries, the money movements. And what I'm going to do that is we're going to go through a practice set of questions. These are going to be the best set of questions available to you. They're going to be better than the books. They're in Excel. Don't worry about that though if you don't like Excel. They just simply put your numbers in the box, but they turn different colours about whether you're right or wrong, and they're a much more effective method of learning double entry bookkeeping. To explain where that comes from, I learnt double entry bookkeeping as the last of the trainees that did manual bookkeeping as part of their training within a firm. And so we did manual and we did electronic, and we had them on software systems and also in Excel. So I did this as a job, and so I can take you through all the various techniques, and I'll show you how it was translated. I translated it into Excel. So this gives you a bit of advantage, which I don't think you'll see elsewhere within your courses. So, what is double entry bookkeeping really? So we've got a box, and this is the entity. So what we're going to imagine is we've got this entity, this company, if you want to call it that, or alternatively a sole traders who's their trading business, or whatever it is, but we just simply got something called the entity. And double entry bookkeeping lives in the general ledger in that entity. That's where it lives. It doesn't live elsewhere. And money goes in to this entity, and money comes out of this entity. So that's all that's happening in the double entry bookkeeping. Shareholders, so shareholders of a company, or alternatively the sole trader of a sole trading thing, they live outside of the entity. So even if we're in a sole trader in here, there's this entity which is the trading activity. So if we're in, Trotter's Independent Traders, that's Trotter's Independent Traders on the side of the Del Boy Trotter's van. Del Boy Trotter is the shareholder. He's separate to that Trotter's Independent Traders. If we are in a company, we've got the company, we've got the shareholders who are separate to that. We've also got as well liabilities to banks and suppliers and the taxation authorities, what have you. They all live outside of the entity. And the entity, the company in this case, let's say, has its assets, and that's what it owns. So we've got this box then here, which is the entity. It's recording all of these money in and money out transactions. And it's recording them in the general ledger. Now, this money in and money out is a bit like a bath. Bit of a disturbing image here. But we've got some money in, which we're pouring our money in, our water into it. And we're going to take that money out. We might not take that money out right now. We might empty our bath out later on. But we're not going to have any more water in this bath than's been put in. But similarly, when we pull the plug out, all the water that we put in, all the money that we're going to come in, is going to go out, and it's going to go out somewhere. So if you imagine this box then is our bath in here, the money is going to go in, which is our water. It's not going to go out of the bath, staying in there, and then it's going out to somebody. Okay, it's not really going to be, this isn't a magic bath. It can't generate more money than has been put into it, and similarly, it's not some kind of thing that's going to soak up money either. It's not going to sponge it whatever to take it out there. Whatever's going in is going out, and it's going to somebody. So what is double entry bookkeeping really? Well, you've got this general ledger, and it records transactions. You might have heard of daybooks, or you will have heard of daybooks because you will have passed the previous unit. The daybooks just collect the information. They pull it all together. That's all that they're doing. We've got subsidiary ledgers like the sales ledger, the purchase ledger, a fixed asset register, something like that. All that's doing is that's for checking items or to generate actions, an age debtors analysis, something like that, things that we're going to do. So we've got this general ledger, and we've got these things, the day books, which are collecting our information. We've got our subsidiary ledgers, that's just for checking or for actions that we're going to undertake. We take our general ledger information, we take these transactions recorded, and we're going to pull them out, and they're going to create our statements of financial performance and our statements of financial positions. So this is the sort of the action place, really, where everything is recorded in there, but it sits on its own, but these other things flow into it or out of it. They're not really part of it. Right, so what do we record in this general ledger? So what are we recording? We're recording positive money and negative money in our transactions. So for each transaction for the company, there's two sides of it. There's a positive money side of it, and there's a negative money side of it. And that positive money is always going to equal the negative money. If you remember that math, the positive money, the money that's going to go in, is always going to come out as well. Or any money that's gone out is always going to come back in. However you want to work it, there's always two sides of these transactions. And that's for the company. It's not for things like the shareholders or whatever. It's for the company on its own. Now this, when I'm sort of saying in terms of money, the money doesn't have to come in or out straight away. It could come in the future. It could go out in the future. It doesn't actually have to be an immediate movement in money, actually from the bank account. But all it does is represents either cash, either now or in the future. So it's either cash in or out in the future, or cash that we've got a hold of now. So who's getting this money? Well, we've already sort of gone through this a little bit. So money held by the company, that's going to be an asset. That's going to be either something that the company actually has as cash now physically within its bank account, or alternatively it's going to be something that it can turn into cash. So something like stock that it's going to sell and turn into cash. Something like its debtors who are going to pay off their debts, and that's going to be cash. Something like a piece of fixed asset machinery, or it could either be sold and turned into cash, or alternatively we could use it to make profits, and that's going to turn into cash. Whatever it is that you've got in your business that can be turned into cash or is cash at the moment is an asset. It's something positive. It's positive cash. Positive cash is equal to assets. A money out item is something that's going to go out of the company. So in our bath, our water going out, and it's going to go out to one or two people. It's either going to go out to somebody who doesn't own the company, and they're called liabilities. So the bank, the taxation authorities, our purchase creditors, anything that's a liability, money that's represented, something that's going to go out in the future to somebody else. We also have someone who owns the company, and they're the shareholders, and they can be called shareholder capital, just capital on its own, equity, reserves. So this money coming in, our water going into the bath, those are assets. That's our cash. It's our cash or future cash. They're going into the bank. They're assets. Money out, the water coming out of the bath, it's either going to go to people who don't own the company, the liabilities, or somebody who does own the company, and our shareholder capital. Now, this is where something like dead clicks doesn't really work, and why we do something like this, where if you've got any kind of anachronisms that you're using with debits equals expenses and assets and drawings, whatever, forget it, it's rubbish. Don't be using that. Instead, we just need to consider our transactions. And in our transactions, they don't necessarily have to be a money in and a money out item. It doesn't have to be but one of each. It could be two of each, two of one side. So a transaction only really actually has to have a positive and a negative money movement. That's all it has to have in terms of a transaction. So it needs to have a positive movement and it needs to have a negative money movement. It could be two or more money in items, and one could be going up, the positive movement, and one could be going down, the negative movement. It could be two or more money out items, with one going up, which will be the negative movement, and one going down, which will be the positive movement. So this is where I think the use of some kind of anachronisms or where these appear and what's a debit and what's a credit doesn't really work here, because in reality, when you're producing your journals, it's not really appropriate. What is appropriate is what is the money movement, what is the positive money movement, and what is the negative money movement. And something that an asset can be a positive money movement or a negative money movement. Assets going up is a positive movement, but assets going down is a negative movement. That would be a credit. So it doesn't. Something like dead click doesn't work. Now, if we put our money movements, we can put them on a number line. Now I'm going to put them on a number line here, which is an accountancy number line. It's different to the traditional one that you would have seen, where positives are positives to the right and negatives to the left. I'm putting in the way in which accountants use this, which is positives to the left, which is our debits. And so they're positive money movements, and negatives to the right, which are also known as credits, which are our negative money movements. Now, here we've got our money out, and if a money out item is decreasing, that's positive. So we owed somebody something, actually that's gone down, we don't owe them as much anymore, that's a positive money movement, so that would be a debit. But if we now increase that money out item, so we owe somebody something more, that's going to be increasing, that's going to be negative money, that's going to be a credit. A positive money in item, if we receive some cash, and we now got some more cash in the bank, that's going to be increasing, that's positive money, that's going up, that's a debit. Something where we've got our money in and it's going down, then let's say we've bought something for cash, so our cash is going down, that's a negative money movement for that item, so that is a credit. So you can see how from a journal point of view, this really sort of focusing on the money movements actually gets your journals right. Focusing on some kind of anachronism means you can't get that. You can't get that right because it will only be right half the time. Now this is an important one which we're going to tackle now then. So why is profit a credit, a negative money movement, if it's a good thing? Profit is a good thing for a company, that's why they exist. If there wasn't profit, there would be no point in having a company. We'd simply shut it down and move on. We have to remember, when we go back to that box, it's the entity, it's the company. The shareholders are sitting outside of that box. This money movement that goes to them represents money that's going out. When we pull the plug on the bath, the money flows out. It flows out to the people who've got liabilities, but it also flows out. Everything that's left, it goes out to those people who are shareholders. So this money movement to shareholders is negative for the company. Positive for the shareholders, they want the cash, but it's negative for the company. So if a company makes profits, and the way in which it makes profits is there's a transaction where assets is greater than the liabilities, so assets minus liabilities is greater than zero, then that profit will flow out to the shareholders, and so that's why that is a negative flow out of money from the company, and that's why it's a negative. And then you can see why it is that DeadClicks doesn't really work for journals on its own. You really have to consider the money movements, and the only thing that DeadClicks is going to work for is to just determine whether something is a money out item or whether something is a money in item. This sort of expenses, assets, drawings would be considered as a money in item. Even then, it's a bit weak, really. I'm trying to give an excuse for why people use it. I can't really find a good one over the long term in terms of how things would help with your studies. So, why does positive money always equal negative money? I'm giving this bath analogy where you can't have a magic bath that generates money and it generates water, so whatever you put in is going to come out. But why does this actually really happen in reality? Well, every transaction is going to affect one or more of assets, cash for the company or future cash for the company, liabilities, either something where our money is going to go out to somebody who's not a shareholder, or shareholder capital, money that's going to go out to somebody who is a shareholder. So we've got this accounting equation here, assets equals liabilities plus equity. And what this really means is that money in is money out, effectively. That's what it's sort of saying. Now, why does this work? Well, let's imagine that we shut down the company. We pay off all the liabilities with our assets, and we've got some money left over. So our assets were greater than the liabilities. Who gets that money? Well, the shareholders get that money. The equity gets whatever's left over. So they will get whatever profit's been made over time, whatever money that was put in initially, whatever's left over, that's what those shareholders are getting. So they're always going to get what's left over in there. They're never going to get any more, but they're never going to get any less either. And because of that, there's going to be a balancing item that's always going to be the equity amount that they get. As a consequence of that, because the shareholder amount is always moving to make sure that assets equals liabilities plus equity, and whenever there's a movement between assets and liabilities, the equity amount is always the balancing figure. Then the money in is always going to be equal to the money out. Let me show you how this works. So let's say because of an accounting equation, there's a transaction. Right? This transaction happens where the positive money movement from an asset, so we've sold something and we've now got a debtor, is greater than the negative money movement. So we've got this some kind of thing where our asset has gone up more than our liabilities on its own before we consider equity. Well, who gets the difference? Well, if it's greater than the negative money that's arrived from those movements in assets and liabilities, so let's say that our assets are greater than our liabilities in this transaction. Well, the shareholders get to keep that money. They're going to take that. That's profit. They're going to have that in there. And so they're going to take that money, not necessarily straight away, but they're going to take it at some point in the future. It's going to go out to them. So that represents money out, negative money, and it's the balancing figure. So assets always still remains assets equals liabilities plus equity. Let's try it in a different way. Let's say because of the accounting equation there's a transaction where the positive money movements are less than the negative money movements. So we've made a loss. Well, this gets taken away from the amount that we can give over to the shareholders. So they previously would have had a figure, but we've made a loss on this transaction, so they're going to have a lower figure that comes out. Again, they come in and they just balance up this equation. So we still end up with positive money is equal to negative money. The positive money that we got from the asset movement less the negative money that we got from the liability movement. The equity comes in. Now it's less, it's a lower money out figure, so that's a positive money movement. So they just balances it up, and therefore we always end up in the situation where positive money is equal to negative money. There's no escape from it. So let's go through then our aims and just conclude this section before we move on to the next bit in our technique. So ultimately you can't escape mathematically for every transaction positive money is equal to negative money. We can't escape this math. We can't escape the fact that the water that goes into it is always going to be the water that comes out, and the reason why is because when all the transactions are added up, money is equal to money out, and that's because assets is equal to liability plus equity. The amount to the shareholders always moves up or down depending upon the difference between assets and liabilities in any transaction, so it will always balance in there. Now all that double entry bookkeeping does is just record the money flows in the general ledger of the entity. That's it. So that's all we're going to do is we're going to look through what is the money flow, and then we're going to turn that into a journal, a record within the general ledger, and then that will be how we create our double entry bookkeeping. Every transaction is recorded as a journal, so we're going to now go through the technique. So hopefully that gives you the understanding, and now we're going to do the technique, and then we're going to do some practice questions. So in terms of the technique, we've got two ways you can do this. First of all, two types of pictures which are just helpful in this technique. We've got our accounting equation here, assets equals liabilities plus equity. This equity is always moving to make sure that this thing balances regardless of any financial transaction. So we have our money in equal to our money out ultimately. Now if an asset is going up, that's a positive number, that's a plus in there though, that's going to be a debit. If the asset is going down, it's a negative number, that's a credit. If the liability or equity is going up, that's increasing, that's a negative money movement, that was called a credit. And if the liabilities plus equity is going down, that's a positive figure, so it's a reducing money out item, and then that's going to be positive money, and that's going to be debit. We've got picture 1, which you could use. You could also alternatively use picture 2 as a number line, which I've shown you previously. So if we've got our money going out, our money out item, and that's going down, well that's a positive money movement, so that's a debit, that's a plus. If our money out item is increasing, that's a negative money movement, that's a negative, that's a credit. If our money in item is going up, that's a positive money movement, that's a debit, that's a plus. If our money out in item is going down, that's a negative money movement, so it's decreasing, it's negative money movement, that's a credit, that's negative. Now I put it like that because if we're in a manual system and we've got a T account in here, then we would have our debits on the left and our credits on the right, and that would be how you could have almost like our number line at the top here, and this is how you can help and understand a manual system. If we're in an electronic system, we would simply have them in one column with pluses being the debits and minuses being the credits. So technique, and what we're going to do then. So we're going to now do our steps. So step 1, we identify what items are moving, so we just simply work out what are the items. We then identify whether they're money in items or money out items for the company. Remember, for the company, forget about the shareholders. If they're money in items and they're going up and the money movement is positive, then therefore they're a debit in a manual system, or they're a plus in an electronic system. If they're money in items and they're going down, then the money movement is negative for the company, then there'll be a credit in a manual system or a minus in an electronic system. If they're money out items and they're going up, if the money movement is negative for the company, then it's a credit in a manual system or a minus in an electronic system. And if the money item's going down, then the money movement is positive for the company, then that would be a debit in a manual system or a plus in an electronic system. So that's really the sort of technique. So that's step 3. You decide out. I already identified in step 2 whether it's a money in or a money out item. In step 3, we decide what the movement is. We then put that as a journal. We add them all up to see whether our debits equals our credits. They should be equal. If they don't, it means that you've made a mistake. And then we post it to the general ledger. T accounts in a manual system. So that's what we're going to do. Yeah. So what we're going to do now is I'm going to take you through, we're going to practice our journals. I'm going to take you through a spreadsheet. You'll see how this works, and it really will tighten up all of your postings and your journal items and what have you. And really this kind of polish before we go into the rest of this unit. We're going to polish up our double entry bookkeeping now. We're going to learn how this spreadsheet works as well, because this is also going to use this as well for all of the other transactions. So when we get into accruals and prepayments, which will make a lot more sense using this kind of question approach. I'll give you the link for the questions in the description. So we've got some questions here. I've provided 24 questions for you, and this is a completed example here. So what we've got is we've got some journals. We'll have some descriptions. We're going to take those descriptions, we'll identify what is the money in or the money out item. We're going to decide the movement in that money in or money out item, when that creates a positive movement, which will be our debits, or a negative movement, which will be our credits. Check that the journals balance. We've then got some amounts in our opening balance sheet. We're going to put those into the opening balance sheet. Then we're going to take those opening balance sheets. We've got some workings over here. You could do this on a piece of paper if you wanted to practice your exam. Or you could use the spreadsheet and the T accounts. So you can put these opening balances into your T accounts, put the journals into your T accounts, balance off the account, put the figure, the brought down figure into the accounts. Remember, the carried down figure is just simply to balance off the accounts and check that your account balances. It's the brought down figure that's the figure, that's the actual amount in the account, and that's what goes in your closing balance sheet. We're going to put those in our closing balance sheets, check that then our balance sheet balances, our closing balance sheet balances, and we'll be away. So this is an example of how it completes. I'll use number 24 because that's the last one. You might not use it yourself. So let's go through. Buy a car. So we've got a car with no VAT, so we're not paying any sales tax on it, which we'd have to pay over to customs, which we'd get back from customs revenue in this instance, and we can buy it from the bank. So we've got 2 items here. They're both money in items. They're both assets. So the car is going up. That's positive. So that would be the debit, 6827. And the bank, and when we pay the money going out of the bank's going down. So that would be the negative, which will be a credit, 6827. Our journal balances. There we go. That's the first one done. Make £11,000, 10,800 for sales. For cash straight into the bank. So bank, including VAT. Okay, so the bank was the positive movement. That's what we got cash going in, 10,800. So that's our negative. That's our debit. We have to pay over to the VAT, and the simplest way to do that would be a 6 because it's including VAT. What I'm going to do here as well is I'm going to use a lot of different terms that you might see in the exam. So we'll have including VAT, before VAT. We'll have into the bank, sales day. These will all have various different meanings that I'll just take you through as we go through. So we've got our VAT. Yeah, now who's getting whatever's left over? Well, the shareholders are getting whatever is left over. That's money out of the company. So that'll be an increase in the money out item, which will be a credit. So they are going to get what's left over, which I think is £9,000. There we go. So that's the second one. Right, so we made £11,000 worth of sales in the sales day book. So in the sales day book, which means they haven't paid it, it's not into the bank, it's a debtor, before VAT. Alright, and we've used before VAT here. So our sales before VAT, the amount that we're going to have to pay over to the shareholders eventually, £11,000. The VAT on that would be 20%. That's what we're going to have to pay out. So that's our money out item. It's going to increase because what we're paying out, so it's going to be a credit. And our debtors, the amount that our customers have to pay us, are going to be those 2 items there. That's what they're going to pay us. That's the increase in the money in item, the asset increase in the assets. That'll be the debit. Okay, make 13,200 of purchases. Ooh. Purchases from the bank, including VAT. Ooh, let's get that right. Sorry, including VAT. There we go. Okay, so the bank is what we're going to get. Is our money in item, but it's going down. So it's a reduction in our money in item. So it's a negative cash movement. So it's a credit. So that'll be 13,200 from the bank. Now we're going to be able to reclaim back that VAT on that. So that's going to be a money out item that's actually going down. Because VAT is a liability, but it's going down. So it's going to be a positive money movement. So divide that by 6, and we're going to get that VAT back. So a positive money movement from us in the VAT, which is going to be a debit. Now, here, the shareholders will not have the difference between these two available to be able to have money to go out to them in future. So that's going to be a reduction in the money out item to the shareholders. So that's going to be a debit. It's a positive money movement because we're going to give them less money in the future. So that's why the purchase is a debit, and that will be 11,000. Right. Rent invoice. So we've got rent, including VAT. Okay, and it's to be paid within 30 days, which says we haven't paid it straight away, so that's going to be a creditor. Okay. So we've got our rent, so that's going to be, let's do the easy one first. Always do the easy bit first. So it includes VAT and it's a rent invoice, so we're going to have to pay this out. So our creditors have gone up, money out item going up, which is a negative money movement in the future, which is going to be then a credit. So that's that. We're going to be able to reclaim the VAT, so that's a reduction in our money out item to the VAT. So it's a positive money movement for us, and then we're going to get that money in, so that's going to be a debit. And the rent that we're going to have left over, well, that is the amount, that is the difference that the shareholders now cannot have. So we're going to have less money going out to the shareholders in future because of this expense, so that's going to be a debit because it's a positive money movement for the company. Not a positive movement for the shareholders, but positive for the company, so that's going to be a debit, that's going to be 900. Receive an invoice for telephone expenses, including VAT, and it's paid via direct debit. So okay, paid via direct debit, it's saying it's coming out of your bank account. Okay, so it was coming out of the bank account, so that's a negative money movement, 120 credit. The VAT we're going to get back, it's going to be a positive money movement, so 20 debit. And the shareholders will not get this money, because that's less money available for the shareholders, so that's going to be an expense for them, so that's going to be a debit. Make £156 worth of purchase expenses for cash from petty cash. Okay, so purchases, and we've got petty cash, and we've got VAT. Okay, so we've paid out our petty cash, so that's a reduction in our asset, a reduction in our money in item, a negative money movement, so that's going to be a credit. We're going to get that VAT back, it's going to be positive money, so that's going to be a debit. And the shareholders, we're going to pay them less money, so it's going to be positive money movement for the company, so that'll be a debit, that'll be 130. Purchase a building. Okay, so let's find this. Building for 22,141 via a CHAPS payment. So what we're saying is from the bank. Okay, it says from bank. Actually, very could have just gone CHAPS payment there. If I wanted to make it a bit harder for you. So 21,141 is the positive money movement in the building. We got this building positive money because we can sell it in the future. So positive money movement. That's the bank. But we also had to pay it out of the bank account. So that's going to be a negative money movement. And so that's going to be a credit. And can you see how this consideration of the positive and the negative money movements is way more effective than something like dead clicks or what have you, where you're sort of considering these items and thinking, oh well, bank is a debit, isn't it? Well, no, it's not, because it's going down, so it's a credit. It's a negative money movement in that instance. Right, purchase fixture and fittings from the bank. Okay, so the bank's going down, 5008. And its fixtures and fittings are going up. 5088. That was the positive money movement. That's the negative money movement. A customer pays a debt. So the customer's paid a debt. They paid it via backs, so they're telling you that they paid it into your bank account. Okay, and so our debtors have gone down. So it's a reduction in a money in item, so a negative money movement, so that would be a credit. And our bank has gone up because they paid the money into the bank, so that's a positive money movement into the bank. So that's our debit. So those are our items there. So we've done our 10 journals. Right, now let's go through these things. So bank is going to be positive money, that's a debit. Buildings, positive as well, positive money if you decide to sell it in the future, so that's a debit. Fixtures and fittings, same, that's also a positive money movement. The car as well. Now the creditors is something we have to pay out in future, so that's going to be a negative money movement. The debtors, money we're going to get in, so that's positive money movement. That's debit. Petty cash, it's either cash or things are going to be turned into cash. Well, it's cash then, so that's going to be positive, so that's a debit. VAT, we're going to have to pay this out in future. Now, in fairness, VAT could be, as we have seen here, either a credit if we're selling things and we've received some money which I have to pay over, or a debit in which case if we've been buying things and we've paid out some money that we can reclaim back. But typically VAT is always going to be considered as a creditor. Have a look at it in the exam. It could say VAT owing, or it could say VAT due. If it's VAT owing, then it's money that you're going to have to pay out in the future, so it will be negative money, so it'll be a credit. If it's VAT due, it'll be positive money because you're going to get it in the future, so it'll be a debit. Shareholder capital. So we're going to have to pay this out to those shareholders eventually. They want that money back. So that'll be a credit. And there we see our balance sheet balances. We're doing rather well so far. Right, now let's go through and transfer then these figures into our T accounts in here. And our creditors there, our debtors here. And so this is how you would do this in an exam. Now remember in the technique method in the exam where I'm sort of saying that the examiner is trying to see whether you will rush, and you'll avoid trying to do this and you'll just simply get your calculator out and start adding things together. Don't do that. Don't be a sucker. Just do the thing properly and prepare your T accounts. And there's our car and here's our bank. And then we've got some sales. Now this is going to be a lot of putting in various different items in there, so I've sort of gone through and put them all in into my debits and credits, and now I'm going to balance off my accounts just to show you how they're going through. I've also shown you a method that you could use as well to go through and just check your debits and credits if your balance sheet doesn't, and you simply just sort of tick them as you're going through. And this is where, by laying these things out in your T accounts, if you do get a mistake, then you make sure you're always right. So let's now do the buildings one here, which is going to be those two there. It's actually too fair. I'll do this properly and I'll balance off my items. Here, so I've got my fixtures and fittings, should be that one there, and my car should be that there. Okay, I've got my debtors. I'm going to make a slight, just take a few, I'm going to slightly shortcut it. Really, I'd put that as my carry down figure in there. We'll go carry down, and that would be the brought down. Remember, the carry down is just to get these your debits and credits to be equal to one another. Your brought down is actually the balance that goes into the balance sheet. So here's our debtors here, and then pressure on all this to see whether we're going to get this right. There's our petty cash, and there our creditors. Creditors is that one. VAT is going to be a little bit tricky. Let's do this as a proper carried down, brought down kind of balance, shall we? Minus. Yeah, let's accept that. And so that would be our brought down. So our brought down is a creditor of that figure. Our shareholder capital is here. Our sales figure is those credits there. We've got our purchases, which are here, and our rent there, and a telephone there. Okay, so there's my trial balance. Let's just now see if it adds up, shall we? There we go. Oh, sorry, hang on. Let me do it on the cell where the total is. That one, and yes, it balances. If you do it, when you're adding these things up in here, just check that they're balancing there. If you pick a different cell, it sort of tries to link against something else. I've set it up for future questions as we're going along. Don't worry if it turns red. It's a question of whether that just balances or not. So what we can see here is we've gone through our approach and our steps. We've identified the item. We've then worked out whether it's a money in item or a money out item. We've worked out whether it's going up or whether it's going to go down. So that's allowed us to work out our debits and credits. We've done the same for our opening balance sheet. We've then put everything into our T accounts. I've shown you a method here where something you can sort of check and just tick off as you're going along as well. If you want to, if you get an error, let's say, I just wanted to be able to show you that. Here, and then you drop it into your closing balance sheet. Here, this is our closing balance sheet here, and you see whether your balances. Well, hopefully that was useful for yourselves. Good luck. Thanks a lot. Thanks for listening. Bye bye.